Assalamualaikum and hi. My name is Muhammad Faisal Idraki bin Muhammad Junaidi.
My name is Nur Anis Adawi binti Zaman.
Hi, my name is Nur Fatim Ifawadiah binti Ghaffar.
Assalamualaikum and hi. My name is Ahmad Syahmi bin Jalil.
Hi, Assalamualaikum. My name is Muhammad Syahmin bin Nasri.
Our group chose the post-ledger company for MFRS 116 property, plant and equipment. For the measurement, items of property, plant and equipment are measured at cost less any accumulated depreciation and any accumulated impairment losses. Costs include expenditure that are directly attributed to the acquisition of the asset and any other costs directly attributed to bringing the asset to working condition for its intended use, and the cost of dismantling and removing the item and restoring the site on which they are located. The cost of self-constructed asset also include the cost of material and direct labor. For qualifying asset, borrowing costs are capitalized in accordance with the accounting policy on borrowing costs. Okay, after that, I will explain the four rate connection. When a significant part of an item of property, plant and equipment have different useful life, they have accounted for as separate item or major component of property, plant and equipment. The gain or loss on disposal of an item of property, plant and equipment is determined by comparing the proceeds from disposal with the carrying amount of property, plant and equipment, and is recognized within either income or other expenses respectively in profit or loss. Lastly, for disclosure, depreciation is based on the cost of an asset less its residual value. Significant component of individual asset are assessed, and if a component have a useful life that is different from the remainder of the asset, then that component is depreciated separately. Depreciation is recognized in profit or loss on a straight line basis over the estimated useful life of each component of an item of property, plant and equipment from the date that they are available for use. Freehold land is not depreciated. Property, plant and equipment under construction are not depreciated until the assets are ready to their intended use. The estimated useful life for the current and comparative period are as follows. For the building, 50 years, building improvement and renovation 2 until 50 years, plant and machinery including ground handling equipment 10 until 20 years, motor vehicle 5 years, furniture and fitting, office and computer equipment 3 until 10 years, vessel 9 years. Depreciation method, useful life and residual value are reviewed at end of the reporting period and adjusted as appropriate. After that, I will explain MFRS 140 investment property. For measurement, investment property are properties which are owned for right of use asset held under a lease contract to earn rental income or for capital appreciation or for both, but not for sale in the ordinary course of business used in the production or supply of goods or service or for administrative purpose. Investment properties which are owned are measured initially at cost. Costs include expenditure that is directly attributed to the acquisition of the investment property. The cost of self-constructed investment property include the cost of material and direct labor. Any other cost directly attributed to bringing the investment property to a working condition for their intended use and capitalized borrowing costs. Subsequently, investment property are measured at fair value with any change they are recognized in profit or loss for the period in which they are arise. When the fair value of the investment of property under construction is not determine the investment property under construction is measured at cost until either its fair value become reliable, determinable, or construction is complete, whichever is earlier. Lastly, for investment property, I will explain about disclosure. Okay. The group estimate the fair value of its investment property using investment and market comparison method. The fair value of investment property is determined by external independent professional value, having appropriate recognized professional qualification and recent experience in the location and category of property being valued. The independent professional value provides the fair value of the group investment property portfolio annually.
Now, for the company Boston Heavy Industry Corporation Berhad, there are two MFRS involved, which is MFRS 116, Property, Plant and Equipment, and MFRS 140, Investment Property. Now, I will explain about MFRS 116, Property, Plant and Equipment. For measurement in this company, it's about capital working in progress, consists of assets under construction or installation for instant use as production facilities. The amount is stated at cost and not depreciated until the asset is fully completed and brought into use. The carrying values of property, plant and equipment are reviewed for impairment when events or changes in circumstances indicate that the carrying value may not be recoverable. Okay, next, for the recognition, an item of property, plant and equipment is recognized upon disposal or when not future economic benefits are expected from its use or disposal. Any gain or loss on the recognition of the asset is included in the profit or loss in the year the asset is recognized. Lastly is disclosure. The carrying value of property, plant and equipment are reviewed for impairment when events or changes in circumstances indicate that the carrying value may not be recoverable. The residual value, useful life and depreciation method are reviewed at each financial year end and adjusted prospectively if appropriate.
Agriculture with MFRS 140, which is investment property. An investment property is real estate property purchased with the intention of earning a return on the investment, either through internal income, the future resale of the property, or both. First fund for the Boston Heavy Industry Corporation Berhad. Investment property is initially measured at cost, including transaction costs. Subsequent to the initial recognition, investment property is measured at cost less accumulated depreciation and any accumulated impairment losses. All other repair and maintenance costs are recognized in profit or loss as incurred.
Next, we move to the differences between the selected MFRS, which are MFRS 116 and MFRS 140 with MPERS. So the first is the differences between MFRS 116, Property, Plant and Equipment, with MPERS. So the first is the barrier plans. MFRS 116 scope out biological assets related to agriculture activities from its scope entities account for barrier plan in accordance with the standard, while for MPERS, according to Section 17, do not scope in barrier plans. This means entities using MPERS account for their barrier plans under Section 34 specializes activities instead of this standard. For the second differences is depreciation of the property, plant and equipment. For MFRS 116, require entities to review the residual value, the useful life, and the depreciation method of an asset, at least at each financial year end. MFRS 116 explicitly states that a depreciation method based on a revenue that is generated by an activity that includes the use of an asset is not appropriate. While for MPERS, Section 17, however, requires entity to review them only where there is an indication of significant changes. Next, we move to the differences between MFRS 140 investment property with MPERS. So the first is the subsequent measurement. For MFRS 140, provide an accounting policy choice to either use the fair value model or the cost model. Entity must apply the accounting policy chosen consistently to all of its investment property. There is a reputable presumption that an entity can reliably determine the fair value of an investment property on a continuing basis. While for MPERS, according to Section 16, on the other hand, by default requires entity to measure investment property at fair value. No accounting policy choice is available. However, if an entity cannot measure the fair value reliably on an ongoing basis, the entity account for it using the cost model. Entities account using them cost model until a reliable measure of fair value becomes available and reliably measure on an ongoing basis. The next difference is the disposal. For MFRS 111, the next difference is disposal. The disposal of investment property according to the MFRS 140, an investment property is derecognized on disposal or when the investment property is permanently withdrawn from use and no future economic benefits are expected from its disposal. While for MPERS, there is no section related to the disposal of investment property. Next is the disclosure. According to MFRS 140, required entities to disclose the fair value of investment property measured using the cost model. This means, although entities adopt the cost model, entities will still need to determine the fair value for disclosure purpose. While for MPERS, there is no available in Section 16 related to disclosure of investment property. Lastly is the presentation of investment property. According to Section 16 of MPERS, it is required entity to present an investment property not measured at fair value separately in the statement of financial position. While for MFRS, the presentation requirement that state in Section 16 MPERS is not required in MFRS 140.
To conclude all of our finding in this assignment, we can say that the reporting standard met by MASB for plant, property and equipment really help the company to report the usage of the asset financially as well as how the finance of the asset are being handled. It also help user to understand how make the company manage the asset to help the make economic decision. We can see the objectivity of the MFRS, which is to determine the accounting treatment for plant, property and equipment (PPE), is working to help the user of the financial statement that may be concerned about the information about an entity investment in property, plant and equipment, as well as change such as withdrawal in the investment. It is important for large company mostly to apply the uses of MFRS 116 because such item of property, plant and equipment qualify for recognition as asset because they enable an entity to derive future economic benefit or service potential from related asset in excess of what could be derived had those items not been acquired. We can also recognize the impact of the using reporting standard, which is all lists will be accounted for on balance sheet other than short-term and low-value asset lists, and list expense will typically be front-loaded. As the new standard consider all lists as financing arrangement, a list will always recognize and present in the income statement amortization of lease assets separately from interest on lease liability. The impact on income statement of the new model will depend on the significance of leasing to the lease and the length of each lease. Earning before interest, tax, depreciation and amortization (EBITDA) is likely to increase compared to the amount reported today because a list will present the implicit interest component operating lease payment as part of finance cost, whereas today the entire lease expense is included within operation cost. The net profit, however, is likely to decrease because interest expenses is typically front-loaded as the combined effect of amortization of lease asset and interest on lease liability is higher in the early year of a lease than in the later year, and vice versa. Over the lease term, the total amount of expenses recognized remain the same. Impact on the cash flow statements consistent with the balance sheet. The new model reduced operating cash outflow with a corresponding increase in financial cash outflow for principal repayment. Compared to the amount reported today, the reflect the economic of a financial arrangement. As a conclusion, MFRS 116 has a lot of impact on the financial statement as well as benefit for the company who use the reporting standard.